Okay, let's do our weekly update. Even though the week ahead is dull on the economic calendar, there isn't much, and I expect volume to be relatively light for the next 4 trading days. Monday's a holiday. And going into the New Year's weekend, I do expect volume to be light. Nothing really going on. And then, of course, January will be interesting. We have earnings season as well in January. So let's look at rates. Long end of the curve have all increased. All capital market rates have increased week over week. Money market rates seem rather unchanged, except here's our curiosity again. In the 30-day, 3.8%. The effective federal funds rate from the New York Fed is 4.33%. What is interesting here is for the week ending December 23rd over December 16th, the reverse repo facility increased by 90 billion at 4.3, which is 1-day SOFR. So the 3.8, the increase here in the reverse repo, I think can only be explained by a very significant move to cash. And if you can access the Fed window, you're putting your money in the reverse repo. It's still over 2 trillion. That's been elevated for a long period of time. But if you can't, well, where are you going to put your money for the next 30 days to get past? Maybe it was a move to cash to get through the holidays, some tax loss selling, get some cash. Where are you going to put it? Maybe we'll put it in the 1 month. We'll get the rate that we get because it is only for 1 month. So who really cares? And that could be what's going on with that rate because it just is out of line when you consider where the effective funds rate is and where you consider where SOFR is. It just seems out of line. Inversion of the curve, it is steepening. We're only down 56 basis points on the 2s to 10s. So the TUT trade has gained another 13 basis points on top of, I think, 7 basis points last week. So it's a 20 basis point move on that trade. The 3-month to the 10-year, this is pointing at the wrong one. It's over here. The 3-month to the 10-year inverted by 59 basis points. Not as bad as it was the week before. It was 83. That is now 60 days. This is mostly changing because the long end of the curve here, all capital market rates have increased. And this really started with Japan changing its yield curve control policy on the 10-year to 50 basis points on the 10-year to fluctuate within a 25 basis point wider band than they had previously. And it hasn't come out, but volumes are light. So when volumes are light, it's hard to trust the move because usually big institutional money isn't making moves when volumes are light. I think that we'll really start to get direction once we get into January. So at this point, I don't know that I would be making big strategic moves. I'm more apt to make small tactical moves to take advantage of any mispricing or any perceived mispricing that happens because of light volume. FOMC meeting, 38 days away, February 1st, quite some time away. We do have minutes coming up in, I think, 17 days. CPI data for December is in 18 days. That'll be interesting because we had 2 months of declining inflation, and I'm going to show you some numbers which shows declining prices and inflation in a whole bunch of places in the major economies. You still have inflation that's climbing in some of the smaller economies. I've tended to ignore that, but just focused on the bigger ones. The Fed balance sheet still tracking downwards. As per their plan, dropped another 18.57 billion. We're at 8.054 trillion versus 8.072 trillion. We will print a 7 on this in January of 23, and I'm sure that will be talked about. Not that it's anything important going from an 8 to a 7. It's a 7 handle now. So I'm sure there'll be some discussion of that and some renewed interest on what's going on with the balance sheet. Don't they understand that this is constricting economic growth just as much as rates are. It's time for a pivot, and all of that talk will be back in the new year. I don't think that word is dead yet. This 18.57 billion, T-bills down 1.13 billion, U.S. Treasuries down 12 billion, mortgage-backed securities down 5.4 billion, and commercial mortgage-backed securities down 13 million, a measly little 13 million. The probability for February 1st for the FOMC has increased. Last week we had a 75% probability of 50 basis points. That's dropped to just a little under 66%, and more weight has moved to the 75, 34.1%. And I'm going to put a big question mark here because it doesn't make any sense to me why that would happen. We had some pricing data from Q3 when we saw our final look of Q3 GDP, which showed that pricing pressure was higher than originally estimated, but that was Q3. October, November, that hasn't changed anything for October and November, and the PCE also confirmed that as well. So why more weight has shifted to the 75 from the 50, to me, is a curiosity. June is rather interesting. 5.75 is now showing up, although with very small probability. It had zero probability last week. Now it has some, whereas the 4.5 had some probability. Now it has none. These are the tails of the distribution. But all the probabilities have shifted towards a higher terminal rate. Where's the big weight here? 5%. You got 46.5%, 31% at the 5.25. And the terminal rate for the summary of economic projections for the end of the 2023 had it at 5.1, which is a range between 5 and 5.25. So if we're done hiking rates by the June meeting, which is expected to be a zero rate hike, if we're done hiking rates by the June meeting and going to be on hold for a while, it is kind of putting the weight pretty much where the summary of economic projections were, between 5 and 5.25, sitting at 5.1. Moving on to real rates, all of them have increased. Look at this term structure here, 5.7, 5.6, 5.5, 5.76. That is a nice flat term structure. I don't think I've seen that all year. Break-even rates. Not much of a story in there. They've all increased for the week. Nominal rates have increased more than real rates have. So the break-even rates have increased, but not to the point that I would say, well, there's a story here. I don't think there's any story here. Let's look at Fed funds futures, and I have a long position on the December Fed funds futures. Last week, the index and Fed funds futures are priced on an index basis, with the index being 100 minus R, R being the implied effective federal funds rate over that period of time. Each contract is for a month, and each contract expires on the last trading day of each month. So we do still have a December contract hanging around here, but it's not going to change. Because, well, we already know what the rate is, and there's no possibility of the rate changing by the end of the year. It's basically a dead contract at this point. And then each month thereafter. Last week, the index bottomed May and June at 95.165, implying a rate of 4.815, which puts a policy range around that of 4.75 to 5. Not much has changed for the policy range. Nor the months. May and June still bottoming at 95.095, but the implied rate now is 4.915, which is 10 basis points higher, but still within the policy range of 4.75 to 5. December is 95.485, implying a rate of 4.515. Last week was 4.425, so that is up 9 basis points over last week. Let's look at the TLT trade, because it opened up an opportunity to sell some puts. You had a pullback in price, thank you Japan, and you had an increase in implied volatility. So if we look at IVP, which is over here in this corner, I'll draw a circle around it. The 13-week IVP is 28%. Last week it was 8%. And the 26 week is 51%. Last week it was 29, and the 52 week is 56%. Last week it was 45. So you had elevated implied volatility, so more premium in the puts when you had the puts, and you had a nice pullback in price so that you can grab a lower price on the strike. TLT had a bad week. There's no two ways about that. SPY was down 0.09% for the week, basically flat, but TLT lost 4.62%. I have the January 24 115 calls at 650. I have the January 24 110 calls at 715. I sold the January 23. That's in 30 days. The January 23 100 and 250 puts. I sold at the money puts for 235. Now I know there is a dividend between now and the expiration date. We don't know what the dividend is because it's the year-end dividend, but I know there's a dividend. So I'm comfortable with that price. 102.50 minus 235 is $100.15. If it's put to me, that is the average price at which it would be put to me. If we look at where the 50-day moving average is, it's at 100.3. If we look at a 50% retracement, this was the low before the rally. You had a nice rally in TLT, and now we've had a pullback. If you take the low to the high and divide it by 2, you get to 101.31. So I've got 2 points of support below me. I've got the 50% retracement. I got the 50-day moving average. These are technical indicators on a chart. The fundamentals always win. So if there's a fundamental story of why something why there's downward pressure or upward pressure on a price, that always trumps the technicals. But the technicals are there when the fundamental story isn't quite there. You can move to the technicals and say, well, technical traders will sit at these levels, but fundamentals always rule the day. 200-day moving average sitting above at 110.74. So why am I selling the January 23s when I have the January 24s? And this is a strategy you can employ to actually get a better payoff in the end, is rather than match your calls with puts at the same period of time, we follow the strategy here, you can, of buying long periods of time but selling short periods of time. And if you sold, I'm getting greedy here at 235. I'll admit that right off the top, I am getting greedy at 235. The proper way to do that is say, well, January, that's 12 months away, divide this by 12, and you'll get roughly about 52 cents. And I should go to January and find a put that's trading for 52 cents and sell that. And if I sell one every month, it's the same as getting 650 on the put for January of 2024. And I can do this again, divide by 12. But I saw the increase in implied volatility. I saw the pullback. I saw where the 50-day moving average was. I made a quick assessment. We're at the end of the year. I think a lot of this is end-of-year positioning. I don't know that there is a fundamental reason why the long end of the curve will keep rising at this point. I've looked at inflation data that's come out over the last week from large economies. It's all benign. It's all coming down. So I made the calculated risk, or the calculated bet that I think we're going to find support here over the next week, and I think by the time we get to January, TLT will be above 102.50. It will not be put to me, and that will lower the average price of my existing calls by 235 because I match the number of calls I have with the number of puts. If it is put to me, I'm okay with that. So don't copy me, because you don't have the resources I have. At least I'm betting that you don't have the resources I have. And I have a significant amount of cash still, simply because there just aren't very good opportunities, and my cash is earning a great return with no risk to the principal. So why wouldn't I do that until I see things on sale? I have patience. And I think that we're going to have, for earnings season, with the guidance, I think we're going to have opportunities to buy some things at nice lower prices. For the options on TLT, if you go out to January of 2024, what make the calls so interesting to buy is because the distribution is going to be centered around the forward price, not the current price. If we take the 10244 and we use the 3-month SOFR rate, let's say 4.03%, or sorry, 4.3%, and we go out right now 13 months and calculate a forward price, you're roughly around 107.35. That means the 107.50s for January of 2024 should have a delta of around 0.5 for the 107.50s. So if you're looking at January and you're looking at the 102 puts and you're wondering how come there's not a lot of premium in the 102 puts, because we're at 102 right now. For being at the money, why is the delta so low? For January 24, the at the money is 107.35. The distribution of the options will be around the forward price, not the current price. I'm not sure that many of you are aware of that. So because the distribution is sitting at 107.35 and you had low implied volatility, the call prices were rather benign in that sense. But the put prices don't give you a lot of opportunity unless the current price drops a lot to drop the forward price to 102. I don't see that happening, so I may as well take the January 23s as opposed to the January 24s. And that's what I did. We'll see what happens. Okay, so on the screen here is some pricing information just from the last week. And I really just picked on the big economies. I just looked at the data for the Euro area as a whole. There were, and I took Germany as well because it's a large economy within the Euro area. There were smaller economies that last week had either a PPI, a CPI, or wage information or import-export pricing. I just ignored those because they're small and I just took the big ones. So I have Canada, US to cover North America, and I threw Japan in there because, well, let's find out if what they did with yield curve control was the beginning of something and could be a trend, or was simply, as Kuroda said, a one-off. Labor cost index, Q3 year over year came in at 2.9%, previous was 3.8%, so that is a drop. Wage growth for Q3 year over year was 2.1%. Previous was 3.2. That would be Q2. Canada PPI for November, month over month, negative 0.4. Previous was 2.4, negative 0.4. Year over year, 9.7. Previous was 10.1. But, you know, the year over year has some base effects. The year over year is backwards looking. Month over month is just backwards looking as well, but it's the last month. So I tend to look at that as being a more recent effect on inflation, and I think that that's a better number to look at as a going forward rate as opposed to the year over year, because the year over year can disappear with base effects. Raw material pricing for November, negative 0.8%, previous was 1.3%, year over year is 8% versus 8.6%. CPI, we're still in Canada here for November, month over month, core, 0. The core was 0. Previous was 0.4. Headline 0.1. Previous was 0.7. Average weekly earnings for October year over year 3.4%, up from 3.1%. You've got pricing that is decreasing in Canada, PPI, CPI, but weekly earnings are increasing. That's a good thing. Germany PPI. For November, month over month, negative 3.9. Previous was negative 4.2, but it is coming off a high level. Year over year, 28.2, down from 34.5, so the right direction. In the U.S., GDP deflator for Q3 quarter over quarter is 4.7. 4.7 was the previous, no change. It was expecting a drop. It came in as no change. Headline 4.4. Previous was 9%. So that is a significant drop on headline, but core is an issue. But this is Q3, and this was quarter over quarter. These are annualized rates. It's not that it's 4% quarter over quarter. It's 4% on an annualized rate quarter over quarter. But we've already seen CPI for July, August, and September. We've seen PCE for July, August, and September. This is our third look at Q3 GDP. It's very backwards looking. Why the market responded the way it did to it, I don't know, but it didn't make a lot of sense. PCE for November, month over month, core came in at 0.2. Last month it came in at 0.3. Headline was 0.1 versus 0.4. This was very good information. The market didn't seem to respond to that. So I attribute, and that's the day before the long weekend, I attribute that to very light volume. I think most people had probably wrapped up and gone home, and unless there was some really big event when you're off, unless there's some really big event, you don't really do much. You're not going to let low volume second guess your strategic positions. If there's anything tactical, you may take advantage of it, but no one's putting on or taking off important strategic positions going into a long weekend. Same with this week coming up. I doubt there's a lot of strategic repositioning going on this week. If anything, it'll be dominated by day traders and tactical positioning. Japan CPI for November, year over year, 3.8. It was 3.7. They wanted inflation for such a very, very long time. They've got it now. Core 3.7 versus 3.6, being that these are elevated. 3.8 over 3.7, 3.7 over 3.6. This will be something to watch. If that continues that trend, then there might be a change in monetary policy, because there has been no change in monetary policy in terms of their rate. But they did change yield curve control policy at the 10-year. So if, depending on where this goes, we may see even more movement there. And if we do, the yen will strengthen. And if the yen strengthens because the market believes that, well, the Bank of Japan is at the very beginning of its rate hiking cycle and differentials are going to decrease very quickly over the course of the year, if that happens, some big carry trades have to be unwound. That could become a problem. So let's keep our eye on where the yen is. And the yen is going to be dictated by where inflation is going, because that will tell us what the Bank of Japan's governor is going to do. But overall, this is in line with slack starting to show up in the economy. And we are seeing it in economic activity as well. You're seeing, housing sales, pretty much at recessionary levels. We're seeing inventory starting to build at some automakers. These kind of numbers here, CPI at 0% over here, PCE coming in at these kind of numbers. If this continues into January, I think the inflation story really takes a back seat. Earnings in the economy will be front and center, and with earnings heavy on guidance. Okay, we haven't looked at shipping costs for a while. Look at container freight prices, 21.26. Better color there, 21.26. Last time we were looking at it, it was sitting up here on this chart somewhere in the 7,000s, and we're saying, look, it came down from 10,000 to 7,000. Look at the collapse going on over here, 21.26. This is the Baltic Dry Index. This is container freight. So if you're shipping, Nike shoes, you stick it in a big container on top of a ship and you send it across the ocean. This is for iron ore, grains, things like that. 15.15, and this is 15.15. This is going all the way back to this is all 95, 90. Look at these prices. You're pretty much in where the 90s were. You're in where the teens were. This over here, if you were trading at this time, dry ships was probably the best investment you could make, which was a shipping company. It just went straight up. It was beautiful, but shipping rates were astronomical because there was a shortage of ships. Then you had lots of shipbuilding going on. And then you had the recession. Well, once you start building these ships, you have to finish, and they started showing up over here. They started showing up, and we have lots of ships out there. So shipping rates have really come down. Labor costs, this is part of the sticky component. Housing prices, rents, and labor are really where we want to pay attention, because labor will keep services inflation high, and housing costs and rents will keep owners equivalent rents high, although the Fed is saying they are looking at new rents as opposed to the year over year looking at new rents, and those are showing some signs of not increasing at the same rate. They're still going up, but not going up at the same rate. But labor here, and again, this reset zoom button, as soon as you zoom in on something, how can they not be aware of this? Like, it just seems to me laziness how they're just not aware that that reset zoom covers one important line. Or maybe they stuck it way up in the corner when they first did it, going, come on, 7, 8, 9%? When are we ever going to see 7, 8, 9%? It's safe to put the reset zoom button in that corner. So maybe 7, 8, 9% is just, the reset zoom being over that line is just another data point saying, hey, listen, when they first did this chart, they stuck that button there because they never thought this would ever happen. You can live with that. Somebody did give me a method of how to get rid of this, but it involves opening up the code and changing the code. I'll leave it. Put it that way. September, October, November. So let's look at job stayer here. In September, 5.3%. Increase to 5.4%, increase to 5.5%. If you don't want people quitting, you have to start paying them more. However, job switcher, 7.9, did drop to 7.6, but now back to 8.1% for November. That's still a tight labor market when you have job switchers able to switch jobs and suddenly get a pay bump like that. So as much as it has been said about, well, I think we're counting the number of jobs wrong between the establishment survey and the household survey, you can always just go to pricing and say, well, what is pricing telling us? Now, if pricing was telling us a different story, saying, well, job switchers really were only getting the same as job stayers, that doesn't sound like a tight labor market, but job switchers are getting more than job stayers. For overall unweighted, 6.3, 6.4, 6.4, and here again, because we only have one decimal place, we went from 7.6 to 8.1, went from 5.4 to 5.5, but overall stayed the same. Tells me this must have been 6.359 or something, just a little above 3.59, and this must have been 6.446. Just a little under 6.5, so it's rounded down to 6.4. This is rounded up to 6.4, looking like the same thing, but it's not. Government offices, 2 decimal places is not an unrealistic thing to ask for. Let's make that the new legislative mandate for 2023. Some candidate out there, I want you to put this as part of your campaign promise and run on this as your platform. 2 decimal places. We're losing information here. Anyways, labor costs up, shipping costs down. Shipping costs, when you think about what gets shipped, services don't get shipped, goods get shipped. So this is helping to lower goods inflation. But services inflation, if we look at what makes up the U.S. economy, services by far are the dominant category in CPI and in PCE, and labor costs that are going up don't bode well for the sticky components of CPI to come down. However, this, I'm going to bring this argument in later on, this combined with housing prices going down is increasing housing affordability at a faster rate. If you have wages going up at 6.4% and you have housing prices coming down at 4%, because they have quarter over quarter, 3 over 2, you basically have housing affordability improving by roughly 10%. I have more money to spend and the thing just got cheaper. I got 6.5% more money and that house just got 4% cheaper. It got 10% more affordable. So housing prices at these kind of labor wage rate increases, housing prices, especially with low volumes right now and low inventories available, do not have a lot of downside to go. If wages are rising to meet the falling home price, there will be a floor on it quite soon. Mark Zandi from Moody Analytics was on Bloomberg, and he was his thesis is that given the run rate we have of existing and new home sales right now, we are at a bottom. These are recession levels where we are now. Okay, corporate yields. Look at the spreads, the OAS. These are just not responding to anything. Week over week over week, basically flat, not budging, not moving. Here are our yields on let's see if I can get a pen that writes on this. There's our yields. You can sit in, let's say even A or even triple B. You're still in investment grade, get 5.64, as opposed to sit in equities and potentially lose something. 5.64%. So it's a compelling alternative to equities in the face of a recession. Typically, you'd expect to see spreads widen in the face of a recession, but they're just not responding. It could be the combination of attractive, the most attractive yields you've had in a while on corporate bonds, and the extremely low issuance that we've seen. Combined, I guess a third point here, third leg of the stool, would be fairly strong balance sheets overall going into this recession, if we think we're going into a recession. Mortgage rates. This is consistent with a drop in volatility on treasury yields. Look what happened here. 1 week change, down 4 basis points. Even though we saw the 10-year over the course of last week, the 10-year increased by, 27 basis points. The 30-year came in by 4 basis points. Now this is only up to the 22nd. We're missing the 23rd, but if we go to Mortgage News Daily, we saw that the mortgage rate increased by 4 basis points on Friday. Don't know if it's going to show up over here because they are different ways of measuring the rates. One looks at actual market rates. One is a market survey. 6.27. But again, this is consistent with volatility on treasuries dropping. So if you have the volatility of rates dropping, you will have the spread between the 30-year fixed rate mortgage and the 10-year treasury decreasing as well, being that this came in 4 points while the 10-year was up 27 points. That's a 31 basis point contraction in the spread. Housing market index down to 31. That is super low. It has been under 50 now for 5 months. Under 50 is contraction. You can say the housing market is in a recession. When you consider January, beginning of the year, it was at 83, dropping all the way to 31 from January. This is the November index, dropping all the way to the December index, all dropping all the way to 31. Building permits for November down 11.2%. Housing starts for November down 0.5%. That is month over month. Mortgage apps were up by 0.9, refis up 5.96%, purchase index basically flat. Existing home sales dropping 7.7% month over month, but new home sales up 5.8% month over month. Look at the dichotomy in these two. One is down significantly, one is up quite significantly. The median for existing home sales for November, the median sales price was $370,700. That is down 10.4% from the high. From the high price that it registered, it's down 10.4% off its highs, and up only like 4%, 3.5%, 4% year over year, which is a normal price increase year over year. So on existing home sales, that base effect for the last year has basically disappeared, but I don't think we're done at the 370. But look at new home sales. New home sales are always lower than existing home sales because there's way more existing homes than new homes, right? 640,000 on an annual rate. Median price on those was 471,200 because home builders can build whatever they want or nothing. Whereas an existing home exists. You have no choice but to price your home for the market, whereas a home builder can say, well, you want a cheaper home, it's a smaller square footage. Existing homes can't change anything at that point. All they can change is their price. They can't change their features. They can't do anything to lower the average price of the home or the closing price or the transaction price of the home because it is what it is. But a new home, before you build it, if you sell it, you can sell it for the price point that the person wants and you build it to that price point. So 471.2 median price. October was 493 was the median price. We're at 471, so you can see the drop there. If you add the two together, you have a run rate of 4.73 million homes. Now, you go back to January, that was sitting around 7.2, 7.3 million. on an annual rate, 7.2 to 7.3. We're down to 4.73. So this is what Mark Zandi was saying from Moody's, is that how much lower do you want to go here? I mean, that is a significant drop from like 7.2, 7.3 to 4.7 on the run rate. And mortgage rates do keep dropping. We don't have that much more to go with Fed increases, which means it's doubtful that we're going to see the 7 plus mortgage rate again. I think most of the damage on the mortgage rate was done. So I think that if mortgage rates don't go any lower from here, I don't know that they go significantly higher. So I think the market can find an equilibrium here. If the mortgage rate tends to go sideways, well, then this will tend to go sideways as well. I think he's right. I think we are at a bottom because we are probably at a top over here. And if our median prices keep dropping month over month and wages keep rising month over month with a fixed, with a mortgage rate that, let's say, goes sideways, affordability is improving over here. So if you start to get a mortgage rate that's dropping as well, housing, I think, probably has a good future. I've said this for a while. I'm very bullish on the home builders only because of the general lack of inventory that is out there. And if you get any demand coming into this market, right now, most of the home builders have sized themselves for this type of volume, 640,000, 700,000. If you get any volume, a push up to 800,000, 900,000, they win. They win. Okay, if you go to the National Association of Realtors site and you look for the latest existing home sales report, there is a summary that goes with it, a little PowerPoint presentation. Here is total existing home sales, seasonally adjusted annual rate. Look where we are, way down here, 4,090,000. If we go back to the beginning of the year, 6.5 million. You've dropped 2.5 million on just existing home sales. I think new home sales run rate at the beginning of the year was around 840,000, 800,000. So yeah, you'd be at about 7.3 million combined, and we're down to 4.7 million. That's a huge drop. This over here is the pandemic, when the economy shut down and everyone was ordered to stay home and, don't interact with people, don't go out unless you have to. So you had home sales drop significantly. They rebounded quite quickly, but we're at pandemic lows here, 4 million. Here is median price of existing home sales. There was the peak, 413,800. We're all the way down to 370,700. That's a 10.4% drop that we've had in prices already. And if you go year over year, you're only up about 3.5%. There it is right there, 3.5%. This is existing home sales median price, percent change year over year. You can see with the combination of prices coming down, the base effects really coming off very quickly. What do we have here? Total existing homes percentage change year over year. This is last November, December. There's January, and you can see every month was down year over year. But look at this big drop off here for November, down 35.4%. These are already recession level numbers that they're showing here. Realtor confidence index survey. First-time buyers, if we look at the dark blues, making up 20% of purchases over 26% last year. Sales to investors are lower, 14% versus 15%. That probably comes with the higher cost of capital. Cash sales, 26% over 24%. Look at this. Distressed sales. This is not a market that we're going to see a repeat of 2007, 2008, where houses were just dumped on the market because of distressed selling. That is very, very low. And days on market, 24 versus 18. It is taking longer to sell. Do we have anything else? Existing home sales by region, if you're interested in that kind of stuff. But the link is in the description box for this. Okay, sticking with this theme a little bit longer, let's look at mortgage REITs. We'll look at agency and Annaly. And by the way, DHI for the bottom-up analysis is done. But it's a holiday weekend, so I expect that you'll see it, let's see, in Canada it's a holiday Monday, it's a holiday Tuesday, so I expect you'll see it Wednesday morning. The notes for it, the PDF notes that come with it, probably will take another day or two, but the video should be up Wednesday. This is top line here is the 30-year fixed rate mortgage. The bottom line here is the 10-year constant maturity yield. So you can see that they tend to move together. The spread sometimes narrows, sometimes widens. This is as high as 2.81 going back a month ago. We're now at 2.6, so it has contracted. The mortgage rate, as we saw, is now 6.27. So lower U.S. Treasury volatility will equal a tighter spread between the 30-year fixed and the 10-year U.S. Treasury. That gives us higher mortgage-backed security valuation. The spread actually for mortgage-backed securities, really looking at the mortgage-backed security yield minus the 10-year yield to maturity. But we're using the 30-year as a proxy for the mortgage-backed security yield. Not as a proxy, but as a very high correlate to that particular yield. A lower 10-year is a lower 30-year fixed rate, which also is higher MBS valuation. So we have seen the 10-year drop, and we have seen volatility drop. So MBS gets a boost from lower 10-year yields, leading to lower mortgage rates, and tighter spreads between the mortgage-backed security and the 10-year yield. So we can really see the effect that has on some of the mortgage REITs. Agency on October 10th hit a low of 741. Same with Annaly, hit a low of 1525 on October 10th. And if you look at where mortgage rates peaked out, I think it's right around here, October 10th. Mortgage rates just were doing this, and that created huge volatility, which made that spread widen. So mortgage REITs dropped a lot faster than what the value of an MBS would drop by. But look at from October 10th to where we are now. This is Agency up 44.7%. Over that period of time. Annaly up 46.9% over that period of time. And even at 1072, you have a $1.44 dividend on an Agency. It's still a 13.43% dividend yield. On Annaly, it's a 15.71% dividend yield. The earnings of these companies are going to be affected by valuation changes on their assets. However, it is the spread, the net spread that they make, because they don't invest in the treasury portion of the MBS. They hedge that out. They invest in the spread between the MBS and the 10-year treasury, and they lever that up. So that's why they are much more variable or much more volatile than what that spread would dictate. So when that spread decreases, they really benefit from that. So that's been good returns on this. I don't know how much more upside we're going to get in the near term. I think in the long term, I think there's good upside to it, and you're getting paid a nice number to sit around and wait. You're getting paid a very nice number. But I think the big gains, the big fast gains are gone. I don't know how much. I don't know that you're going to repeat this over the next 2 months, that you're going to see another 45%. On either one of these over the next 3 months. The big gains are in. Earnings season begins in about 3 weeks. It begins in 3 weeks. That doesn't mean that these guys report in 3 weeks. It just means earnings season begins in 3 weeks. We'll get some clarity on when they're reporting. And their book value per share will be an interesting number to look at. The last time for the last quarter, Agency, I think, was about 902 book value per share. And it was trading down. Even when it reported earnings, it had a big sell-off during the day that it reported earnings. I don't know why. The very next day it sold off, and I mean, you're missing the point. You're looking at the negative $2 per share that it lost, but that's a fair value gains. You got to look at the net spread income, which is the highest it's ever been in their history. So come on, man, what are you doing? But I don't know that those big gains are going to be back in there, but it'll be interesting to see where their book value per share is, because the market is sort of gotten an estimate of where it may be, 1072 and 2240, but we will see. We got about 3 weeks to go. Okay, let's look at the auto industry. Not a good week for Tesla yet again. Also not a good week for Ford or GM. Ford and GM are both down pretty much around the same amount. Ford's down 6.27, GM's down 6.42. They track each other very closely. Tesla, on the other hand, another bad week, down another 18%. Sitting at a more than 2-year low. You got to go back to 2020 to find Tesla at this price. Although it is coming into a more reasonable forward multiple, it's still got some downside to it. Let's look at what happened. Suspended production in Shanghai early. They didn't do that last year. They didn't suspend production at all, but they had planned suspension of production from the 25th to the 1st. They brought it back one day and canceled the morning shift on the 24th. So one more day of shutdown. So all the way to the end of the year till January 2nd, they reopen. Plus reports of COVID really growing in their factory, that more and more employees are getting sick. You have inventory building. You can actually order a Tesla and get it in a couple of days from the US site. Inventory building, you have discounts in China, $7,500 discounts, plus you have 10,000 miles of free EV charging thrown in there, discounts in China that spilled over to Europe, that showed up in Canada, that are now in the US. So they are sacrificing their margin for quantity to make their numbers by the end of the year. You have no clear CEO at this point in time. It seems that Musk has sort of lost interest in it, and he's hanging out at Twitter over there, and that's causing some concern in the market. New models are showing up at dealer auctions. I mentioned that last week. So the statement that they can sell every car they make is no longer true. They cannot sell every car they make. If they could sell every car they make, you wouldn't have inventory. This is, by the way, the third quarter now that they've had inventory building. For 3 quarters, their inventory has increased. You wouldn't have these kind of discounts going on, and you wouldn't see models showing up at dealer auctions that if there was no inventory, if you still had to wait 8 or 9 months, if there was this big lineup, you'd be able to sell them. Dealers wouldn't be sending Teslas to auction. So there's a demand issue going on there. If we look at their forward multiple, they're now sitting at 22 times estimated forward EPS. Now, I haven't seen the EPS come down. That is estimated forward EPS. The average of all the estimates is 558. That puts them at about 22 times. And just to put things in perspective, GM is 5.4, Ford is 5.7. They're at 22 times. Now, I do think that they do command a higher multiple than the legacy automakers. When I say a higher multiple, I'm thinking 15, under 20. 15 would probably be a fair number, but I'm going to go ahead and put a 17 on it. And I think their 2023 EPS, because it hasn't been brought down, sitting at an average of 558, I'm going to bring it down to 450. So I think a price there is 76.50. They're at 122. Where are they now? 122.19 currently on their price. So they still have, I think, $50 of downside over the course of the next year. I know that some of you out there will probably be thinking, oh, come on now. Way back when I did the video in June, the ice age is far from over, when I said that I think Tesla will end the year at 418. That is an unadjusted price that they've split 3 times. That means they should have ended at 139. I got called a bunch of names for that, sitting at 122. So I was wrong in thinking that they'd drop to 139. They actually went even further. I wouldn't have said that they would have gotten that low, but there they are. They are interesting right now. They've got a very low short interest, 2.46. So I wouldn't look for a short squeeze on this one because it just isn't there. You're not going to get much of a short squeeze, so it has to get a bounce from somewhere. This over here, this is a 5-day chart. You see this spike up here? This is Musk saying he's not going to sell any more shares till at least 2025, 2026. And yay, he's not going to sell any more shares, but it didn't really matter because during the rest of the day, concern about demand started coming back in, and margins, $7,500 price cuts. Also, they have no affordable vehicle, and they still are what would be called early adopter stage. It was like sort of Beyond Meat, when it first showed up. You had the early adopters that rushed in to buy it, and it looked like sales were growing rapidly. But the argument I made 2 years ago with Beyond Meat is when the curiosity dies out, when those early adopters are done doing what they're doing, that's it. This is not a mass market product. It's still a niche product, and I said it was a $15 stock masquerading as a $150 stock. Today, Beyond Meat is some $14, $15, so it's priced where it should be, which is a multiple of sales. They have an industry average pricing. I think Tesla will eventually end up with an industry average pricing as well. That's the argument I made back in June. I don't see that is going to change. They have to slowly become a car company because there is the mass market. Otherwise, they'll always be in this spot. And if they're in this spot, that market is only so big, and maybe they've got that market. But if you have inventory that's building, it means you have spare capacity. Well, you're not building another plant if you have spare capacity. It would be foolish to build another plant with spare capacity, because where's the demand going to come from? Unless you find a way to start selling a $35,000 vehicle or a $30,000 vehicle, you're not going to hit that mass market adoption. Implied volatility makes this interesting. Look at this, 52, the 26, and the 13-week. 13-week, 98%. You've got huge implied volatility. If we look at an at-the-money straddle, which is the 122.50s, because they're at 122.19, look at the money straddle, you're getting 22.25, which is 18.2% of the price. So I saw that and I thought, I can work with that. It is coming to a multiple that I would find interesting. I'd find 17 times forward earnings interesting for Tesla. I'd be a buyer at a more sensible price. I'm not negative about the company or about the product. I was always negative about the valuation for a company that was eventually going to have to be a car company, no matter what you thought it was. Even if you thought it was a technology company or an energy company or a battery company, it is in the end a car company, and it's going to have to compete with other car companies. For the January 20th, 23, expiration in 30 days, I added the 126.67 short straddle, and you're probably wondering, 126.67, that's a weird price. Remember, they had a 3-for-1 split, so all the options would have to adjust for that as well. So you have a 126.67 short straddle. I got 24.11 for that, and bought the underlying at 125.98. That is 19.14% of the purchase price in premiums. One of three things are going to happen. Number one is Tesla is above 126.67 by January 20th. My underlying shares will be called away from me, and I make a quick 19.14% return in 1 month. It is below 126.67, but above the break-even point, because I got 24.11, which means I can close it out and open a new short straddle on Tesla, and hopefully that sticks around. That high volatility sticks around. I can do it again and continually lower my average cost. If it is put to me, I will do the same thing I did with ChargePoint, CHPT. And for those of you who have access to the Applied Options series, I showed you what I did with ChargePoint is I started working my average cost down. And I turned a loser into a winner in 60 days simply by working the options. Tesla's low enough on the price, and I think the big drop has happened already. That where it goes from here, I think, is more of a drift. I don't know that you're going to continue to see 18 to 20% drops week over week. You might, but in situations like that, you roll down those calls. And that's what I did with ChargePoint. I showed you how to roll down the calls, how to sell puts deeper, not deeper in the money, but deeper below where the current price is, and slowly work your way out of trouble. Not only work your way out of trouble, but with a gain. So I find this an interesting game to play right now is, can I, over the course of the year, get my average cost on Tesla down to zero and own some shares for free? It's worth playing. It's not worth playing at 45 times forward earnings when in a bear market. It just isn't. I mean, that to me was a no-brainer, but you don't short this thing because it's too volatile. You can get crushed shorting this thing. But when you're down to 22 times estimated forward earnings, I still think the estimate is too high, and I still think the 22 is too high. But the market doesn't. The market is going to find that this is probably an attractive point to start thinking about picking up a position. And with implied volatility so high, look at that. Come on. You're getting 20% of the purchase price in premiums right away. I'll take that. So I am not so much a Tesla investor at this point, but I am a Tesla trader. I will trade it, and my strategy now is to own an underlying position and use the options to slowly work my price down to zero. I'll either work my price down to zero or it will be called away from me. But as long as it stays under my call price, I will continue to work that down to zero. At some point, it's going to get hard. At some point, it's going to hit a price where it goes sideways for a while. Volatility is going to drop considerably. The premiums are going to disappear. Well, then, if volatility drops, it becomes a less risky stock to hold. And it is a call option on the EV play because if you go back to that video I made, it's called The Ice Age is Far From Over, and I do believe it is far from over. I think that EV has been one really overhyped part of the market, and I said that back in June, that everybody who thinks that they're going to get to the numbers that they think they're going to get to by 2030, it's not going to happen. It's not going to happen. You're going to have to live with internal combustion engines a lot longer than you think, which means the ICE business of GM and Ford right now is significantly undervalued. I think GM is a nice play. I also have Ford as well. I think they're a nice play because they got good enough implied volatility that I can play the options and I can work that average cost basis down. But selling the straddles on these are nice because there's good percentage premium and they become income factories. Because if I have to own them, those are beautiful prices to own what I think is an undervalued part of their business, which is ICE. And I think that over here, the EV part of this is overvalued still. Okay, we're going to stick with autos for a little while longer because there is an emerging story here that I think is important. Toyota, this is from the Wall Street Journal, and this was a couple of days before KPMG released its annual survey of auto executives. Toyota's chief says electric vehicles are overhyped. Converting entirely to EVs could cost hundreds of billions of dollars and make cars unaffordable for average people. We're seeing that. Moving to all EVs would leave some customers behind. This comes as Toyota faces pressure to show it isn't falling behind the industry's electric vehicle race. This was the headline, by the way. Silent majority has doubts about pursuing only EVs. So he's speaking for the industry, saying, listen, I talked to a bunch of people in this industry, and a whole bunch of people are saying the same thing, that this is insane, but they don't want to speak up because, well, they don't want to be canceled, right? Says electric vehicles are one option alongside hybrids and hydrogen power cars. Here's a more full quote. People involved in the auto industry are largely a silent majority. Toyota told reporters that silent majority is wondering whether EVs are really okay to have as a single option, but they think it's the trend, so they can't speak out loudly. The right answer is still unclear. We shouldn't limit ourselves to just one option. Yeah, and I think he's right on that. EV is very attractive if you're a multi-family car living in a house. If you are living in an apartment, which a significant amount of people do, they rent, you don't have the infrastructure for it, and you only have a certain amount of range. And the carbon footprint for making an EV is so significant that you have to drive the EV well over 150,000 miles just to hit a break-even point that if you bought all gas. And if you go back to that video, the ice age is far from over. I made the case for plug-in hybrid that if you're driving 50, 60 miles in a day, every day, you'll never hit the gasoline engine. So you basically got an EV with a much lower carbon footprint on day one. I think he is saying something very courageous, being in the auto industry, to say, when everybody is making the statement, we're going to be this by this year, we're going to be that by this year, by 2030, no more internal combustion engine, we're going to be all EV, 60% by this date, 100% by that date. And he's coming out saying, listen, not going to happen, and it's stupid if you try. And if you read this article, he does say some of the things that I had said in the video earlier in the year, that the cost of getting this done, if everybody tried to do it, the infrastructure just in the battery material simply doesn't even exist today to get it done by the time everybody wants to get it done. And I said in that video that by 2025, 2026, you are going to hit a wall. Where that's it on supply. That's as far as you can go, and prices are just going to squeeze upwards. So yeah, I think he's right on this. Let's look at that KPMG survey. Lots of interesting things in there. Okay, so it's 24 pages long. I didn't highlight anything in this, so we're going to do just a casual reading of this. But we'll look at the main findings, which are on this one page, and then the rest go into detail about each of the questions. This is really interesting down here, but let's just read what we have here. Global outlook: auto executives are more optimistic than in 2021 about the prospects for long-term profitable growth. 83% are confident of higher profits over the next 5 years, compared with 53% in 2021. Well, that's good. They have become more cautious about near-term results, however, given the headwinds facing the global economy. 76% are concerned that inflation and high interest rates will adversely affect their business in 2023. Future of powertrains. This is the interesting part here. Expectations of global electric vehicle sales in 2030 are becoming more realistic. In 2021, executives predicted that EVs would capture between 20% and 70% of the market by 2030. Now they're taking a more cautious view of the challenges of shifting to battery power, with forecasts varying from 10% to around 40% of sales in 2030. Look at the top end, 70% down to 40%. The bottom end, 20% down to 10% by 2030. Specifically, executives have greatly tempered their expectation about EV sales growth in India, poor infrastructure, Brazil, biofuels as an alternative, and Japan, a focus on hybrid and energy sources other than batteries. And we know that Tesla was thinking about India at one point and decided that they weren't going to go into India. There is, though, more confidence that EVs will achieve cost parity with internal combustion engine vehicles without government help. 82% believe that in the next 10 years, that's a long time frame, anything forecasting for 10 years is just, in my opinion, a made-up number. EVs can be adopted widely without subsidies. However, if we're talking about technology, and you say, look, in 10 years that technology will be cheaper, yeah, you're probably right. Without subsidies. And 21%, 3 times the proportion, 21, do not think government should provide any direct consumer subsidies for EV. I don't know how I feel about that number. 21%. If you're surveying auto executives, the vast majority of them come from the ICE side. So what's the ICE side gonna say? Yeah, go ahead and help the likes of Tesla and Rivian. That'd be great. Nah, I think they'd look at that saying, hang on a second, that's unfair. It's unfair to us because, honestly, in the first year of ownership for a fully internal combustion engine, we have a lower carbon footprint than an EV does, just because of what's required to make that battery. And you're going to help them out, and they're actually more damaging right now than we are. So I don't know if I would agree with this statement. They shouldn't provide any direct consumer subsidies. Do you really believe that, or for competitive reasons are you saying that, right? Digital consumers, with the proliferation of new models, entrants, and technologies, executives believe consumer buying decisions in the next 5 years will focus on driving performance and brand image. Data, privacy, and security are also key factors in purchase decisions. Don't know that that really fits with digital consumers, but okay. Car customers are expected to shop increasingly online, opening opportunities for manufacturers to sell directly to consumers, as well as online through dealerships. Traditional e-commerce players will also compete for car purchases. Let's see. Very optimistic about the prospects for after-sales revenues. 62% are confident that consumers will be willing to pay monthly subscription fees for software services such as EV charging, car maintenance analytics, advanced driver assistance, and over-the-air updates. I think that is a big future for cars. It was, I can remember at the university I was at 2010, 2011, I was teaching entrepreneurship courses, and I said, for the auto show, I said, I don't know why there's an auto show anymore. I really don't know why. Companies shouldn't be showing up at auto shows. They should be showing up at CES in Las Vegas, the Consumer Electronics Show, because the vehicle should be an electronic device. Why are they not making this more of an electronic device? I don't know, but this here is moving towards that. Executives think automakers continue to see the insurance market as a key growth opportunity. That's where Tesla's hanging out now. But they have shifted focus from competing against insurers to partnering with them or selling them data, which really is probably the best place that they can be. If they can track the data on how this driver uses the vehicle, that is worth a lot to the insurance company. Why get in the business of insurance when you can sell them just the data that they need? You're collecting the data anyways. That's big fat margin without any contingent liability stream associated with it, and without having to be an insurance company for a period of time, which may lower the multiple that you would be getting. Vulnerable supply chains. Executives remain very concerned about supplies of commodities and components, especially semiconductors, as well as items such as electrical steel and lightweight materials that are crucial to increase fuel efficiency and extend battery range. In response to the vulnerability of supplies, car makers are focusing on nearshoring and onshoring in an effort to reduce their reliance on only one or two countries. New technologies and new entrants. Many executives think Apple will enter the car market and become a leader in EVs by 2030. And the big thing there is because Foxconn has said that they're going to get into the assembly business. Again, years ago, I was saying I don't know why the car auto manufacturers even are involved in assembly anymore. Why not just outsource assembly? It's not a competitive advantage to assemble a vehicle. Magna was perfectly willing to do it. They would have bought all the factories and they would have done the assembly for all of them, and then they could have simply focused on design. That would have been a lot better. But the investment in assembly, is a huge source of or a huge draw on the amount of capital that you need. So if you have a Foxconn and a Magna that are going to do assembly, you can have a whole bunch of a design shop show up that are making one type of vehicle or two types of vehicles. Let's see. Tesla is expected to remain the market leader in EVs. Yeah, I think that they'll still remain the market leader in EVs. Nothing in my video from June said any different. I think they'll be the market leader globally, but in each particular market they won't. They're not the market leader in China. They're not the market leader in Europe. They're the market leader in North America. But globally, when you add everything up, they are the market leader globally. They can continue to be the market leader, but they will be a car company with car multiples, with car margins. They are not a energy company or a technology company any more than any of the other ones will be at that time. Whichever company becomes a leader, 9 in 10 executives say startups will have a sizable effect on the auto industry. And that is true. If you can have assembly outsourced, if I can have assembly outsourced, I simply have to design a team to design something, or assemble a team to design something. And as long as I can get pre-sales and interest, I can have it assembled anywhere. More than 1 in 5 say they are extremely likely to sell non-strategic parts of their businesses, given the massive investments required to compete. Contract manufacturing will become even more strategic going forward. And then it goes into detail. Future powertrains. Look at the difference between 2021 and 2022 that we have here. What percentage of new vehicle sales do you believe will be battery powered? This is excluding hybrids, full battery powered, within each market. So you have Brazil, China, India, Japan, US, Western Europe, and here's the percent. Here, distribution of votes. Look at the distribution, the median value and the mean value. Look at this. Look how the distribution has lowered. Look how fat these distributions are down here. You got these long skews here, but look at the distributions down around 20%, all under 40%, 20%. Whereas look at the difference in the distributions here. Some, even here in China, look at that, almost as high as 100%. Even at 80%, you had big distributions. The US, look at this versus where it is now. Japan, where was Japan here versus now? That is a huge difference in expectations. When do you believe battery electric vehicles will reach cost and affordability parity with ICE without any subsidies? By 2025, by 2030, by 2035. Some saying they already have. They already have? I don't think they already have. Do you believe battery electric vehicles can achieve widespread adoption in the next 10 years without government intervention? A lot saying yes. The light blue is 2022. More saying yes. Some governments are providing direct consumer subsidies for battery electric vehicles. Do you agree with this policy? And that is becoming more negative. There is a no down here. If yes, should these be phased out? Let's just ignore that. In your home country, where will owners charge your battery electric vehicle? Single family at home, that is dropped down. Apartment, garage, parking lot is dropped down. Public or private charging stations is increased. At work, on the street. I don't know that this is really interesting stuff here. Where is it? It gets interesting right here. Looking out to 2030, which of the following companies do you think will be the market leader in electric vehicles? Here was Tesla, and here it is today. Number of votes, 418 versus 223. Number 2 is Audi. Here, number 2 was BMW. Number 3 was Ford. Ford is down here at number 5. Apple, which isn't even on the list here, is up at number 4. GM is nowhere on this list. For all the talk they have of having, so many by 1 million units by 2025, 30% of their fleet by 2030, they didn't even make the list. I find that interesting. Ford is there, but GM hasn't even made the list. Digital consumers, we don't have to read that online. Just looking very quickly. This is about the insurance market. The link is in the description box. You can go through this yourself. I find this one interesting here. Who do you think a consumer would trust to safeguard the data generated by the vehicle? OEM, vehicle manufacturer, by far. A retailer, car dealer, not so much, right? Information communication technology companies, even less trust there. Look where governments are. Almost no trust in governments. But this is interesting here. No one except himself or herself. Only 4 or 5%. But again, these are executives within the industry. So it is no surprise that they say, oh, well, us, of course, right? Us, of course, not the government. It would be interesting if you reverse this and ask the consumer who they would trust to safeguard the data. I bet you these two extreme points would be reversed very quickly. Let's see, vulnerable supply chains. How concerned are you about the continuity of supply for the following commodities and components? And they have lithium, rare earth, semiconductor, steel, aluminum, copper. And you could see far more concern. You got to look at the very concerned, extremely concerned in 2022 versus 2021. Supply chain, recent volatility, commodity prices. I think we'll end it there. There's not much more to see. We've seen the big theme, which is a feeling that this rush to EV and only EV might be a little short-sighted. We're going to end here this week with the SPX. Not much to see on the economic calendar. Shortened week. Canada's only open for 3 days. US is only open for 4. No real big economic reports next week. Housing price index and pending home sales. For January, though, we have 3 big economic events before earnings season really begins. First Friday of January, we have the jobs report for December. We will see December CPI and the Fed minutes before we really heavily get into earnings season. Earnings are coming down, or the forecast for earnings are coming down, 223.31 now. If you exclude energy, the expectation is that Q4 of 2022 will be 3.3% below Q4 of 2021. SPX closed at 38.44, puts it at 17.2 times this forward earnings estimate. That is most likely going to come down if we are expecting a recession Q1, Q2, if we're not already have entered one by the end of December, based on the leading economic indicators. That's going to have to come down, and if we are heading towards a much more significant slowdown, this multiple will have to come down to be a little bit lower. So if this drops to 210, let's say, and your multiple drops to 16, you're sitting at about 3,350 to 3,400. 16 times earnings. This level right here is sitting at 356.28 on SPY. For the upside, both the 50 and the 200-day moving average are now resistance. The upside, 387.91 for the 50. We're sitting at 383. The 200's at 486. 18 times earnings is at 400, and the downtrend is 402.54. Can we see 400 by the end of the year? You got light trading next week. You have 4 days, 100 points, 170 points to the upside. Well, 156 here, 156 to the upside. I don't know. I just don't know if we have it, if the market has it in itself to get there. For the downside, where do we have support? The uptrend is at 380.59. We're just sitting above the uptrend line right now. Support at 370.40. That was the last low point on the chart over here. And 16 times earnings, 356, which is significantly lower. Implied volatility, not that great. 13-week is still the 12th percentile. Even 52 weeks, you're only at the 27th percentile, so it's rather low. So, as far as next week, not too exciting at all. I'm basically on hold unless we get some extreme points. So if we trend sideways within a 30, 40, 50 point band all week, then it's going to be a boring week. I probably won't do a single trade. I'm only going to trade, especially with light volume, I'm only going to trade tactically. And to trade tactically, something has to show up. There has to be some extreme point where you say, wow, clearly, I can't trust that point. I'll trade against it. So I will sell June mini S&P futures. The ES is for 50 times the index at 4,100. We're sitting at 4,000 on the June futures contract right now. So remember, the futures contract, to get to the price, you take the spot price and you carry it e to the r minus qt. Q is the dividend yield, r is the interest rate. So it is going to be higher than the spot price because the interest rate is high. So the June futures are sitting at 4,000. That would be 100 points higher. So we'd have to go from 38.44 to 39, well, call it 39.45, 39.50 on the index itself to hit that, to hit 4,100 for June. And if we do get there, I will also add some April 380 puts. I closed some of the puts when we had, if you look at the far corner of the chart over here, these big wicks over here, this push down to 376, 377. I did close some of the 380 puts I had because it was a nice premium above what I paid, so I took it. But I'd be willing to add to the 380 puts on any significant rally. I'm just not going to do it here. I am going to wait until we get an extreme point. So if next week on light volume the market decides to rally up 100 points, 120 points, I will fade that. If we do sell off 100 points over the next week, I don't know what I'm going to do. I don't know that I'm willing to sell puts, only because implied volatility is low. And if we drift downwards, well, it's not going to spike volatility. We would have to drop downwards significantly. Don't know if we're going to get there without institutional support for strategic direction. So I think it's holiday season, which means checking in a couple times each day to see where the market is and just leaving it be till we get back on the Tuesday after next week. And that's it for this week.